Paul, we've seen how when other PE firms convert to a C Corp status, their shares get a pop. Is this decision motivated by moving its shares higher, or is this something that will actually have an impact on its earnings?
Well, Scarlett, thank you for having me. It's actually would have a negative impact on earnings because it would have a slightly higher tax rate. When Carlyle talked about those numbers about a year and a half ago, they talked about roughly mid-teens impact on earnings in terms of the economic net income. However, now that they switched to the distributable earnings, and that impact might be less than 10%. But the multiple expansion well compensates for that.
Paul, when you look at the carried interest setup that these companies had before they switch over to corporation status, is giving that up really worth it, or is this some sort of a read that maybe that carried interest deduction isn't always going to be around?
Well, I don't think there is a read-through in terms of the carried interest deduction necessarily. It just makes more economic sense and more what investors demand from those companies that are much larger now. Their fee-related earnings are much larger than they used to be. They used to make most of their money from the carried interest. Now they make a lot of their money from the base fees like traditional asset managers. So what they're looking for is to get investors to pay adequately for those base fees.
Paul, to what extent were investors pushing Carlyle in this direction? I mean, you could argue that they were pushing it in that direction because they simply weren't chasing the stock higher, maybe the way they were some of the other PE firms.
Well, I think the pressure was on all 4 or 5 large PE firms. So I don't think it was Carlyle specific. It just gotten more Carlyle specific after the first quarter announcement from Blackstone and Apollo.